Я работаю в криптовалюте.
Hi, I'm Satoshi Nakamoto. Welcome to my news channel about cryptocurrency, where the most relevant news and promising projects will be covered.
The Head and Shoulders Pattern, a guide to technical analysis. What is the Head and Shoulders pattern? In technical analysis, the Head and Shoulders pattern stands out as a significant chart formation, signaling a potential transition from a bullish trend to a bearish one. This pattern represents a specific price action structure characterized by three distinct peaks. The two outer peaks are relatively close in height, while the middle peak is the highest. Formation of the Head and Shoulders pattern. Initially, the price of an asset in an uptrend reaches a peak, then retraces to a level no more than 50% of the preceding upward movement, thereby establishing the neckline. Following this initial price pullback, the price rises again, surpassing the previous peak to form the so-called head, only to subsequently decline back toward the original neckline, which acts as a support level following the price correction from the first peak. Finally, the security's price reaches a third peak, typically around the same price level as the first peak of the formation, before declining once again. Trend reversal. The trend is your friend until the bend at the end becomes a popular adage among those who practice trend-following strategies. Indeed, many believe that the Head and Shoulders pattern represents precisely that bend at the end. It is considered one of the most reliable indicators of an impending trend reversal, signaling the conclusion of an uptrend. This formation holds a prominent place in technical analysis, albeit with varying degrees of predictive accuracy. Key takeaways. The Head and Shoulders pattern is a significant formation in technical analysis that signals a potential shift from a bullish trend to a bearish one. It consists of three distinct peaks. The middle peak is the highest, while the two outer peaks are relatively close in height. This pattern begins when the price of an asset, stocks, cryptocurrencies, or forex, reaches a peak, retraces no more than 50% of the initial trend to establish a neckline, forms a subsequent higher peak, referred to as the head, and then retreats to the neckline before forming one more peak. The inverted Head and Shoulders pattern forecasts a transition from a bearish to a bullish trend. The neckline is established along either support or resistance lines, depending on the direction of the trend. Known for its reliability, the Head and Shoulders pattern is considered one of the most dependable indicators of an impending trend reversal, although its accuracy may vary. How to identify the Head and Shoulders pattern? Following a prolonged bullish trend, the price reaches a peak, then declines to hit a low point. Subsequently, the price recovers, creating a second peak that significantly exceeds the initial one, followed by another decline. The price undergoes a third rise, but only up to the level of the first peak, before declining once again. The neckline, drawn across the two troughs, or peaks in the inverted version, serves as a critical reference point. In this pattern, the first and third peaks represent the shoulders, while the second peak forms the head. Furthermore, the support line connecting the first and second troughs within the structure is referred to as the neckline. Head and Shoulders versus inverted Head and Shoulders. Head and Shoulders. A Head and Shoulders pattern that begins within a downtrend is known as an inverted Head and Shoulders, or, alternatively, a Head and Shoulders bottom. Unlike its standard counterpart, this pattern is inverted and is used to forecast reversals of a downtrend. The inverted Head and Shoulders pattern. The following price action characteristics of a security help identify this pattern. Initially, the price drops to a low point, followed by a subsequent rise. Next, the price falls below the previous low, but recovers once again. Subsequently, the price declines again, though not as sharply as it did during the second low. At this stage, the third trough must not drop below the second trough. This condition validates the pattern as a genuine inverted head and shoulders formation. Finally, after reaching this final low, the price begins to climb toward a resistance level, also known as the neckline, established within the price zone near the peaks of the preceding lows. Much like the standard head and shoulders pattern, the inverted head and shoulders pattern serves as a reliable indicator signaling an impending reversal from a downtrend to an uptrend. In this scenario, the asset's price reaches 3 consecutive lows, separated by temporary price rallies. Among these, the second trough represents the lowest point, the head, while the first and third troughs are slightly shallower, the shoulders. The subsequent rise following the third decline signals a reversal of the bearish trend, suggesting that prices are poised to continue on an upward trajectory. How to trade the head and shoulders pattern. Effective timeframes for head and shoulders patterns. Trend reversals initiated by head and shoulders patterns tend to be more effective on higher timeframes, daily, weekly, and monthly, when applied to trending assets such as cryptocurrencies. In most cases, head and shoulders formations observed on lower timeframes, 15-minute, 1-hour, and 4-hour charts, do not serve as continuations of the primary trend for trending assets like cryptocurrencies. Trend reversal signal. The head and shoulders pattern suggests a potential reversal of the current trend. Traders interpret this pattern as a signal of an impending decline in an asset's price, characterized by 3 sets of peaks and troughs, with the middle peak being the highest. The neckline serves as a key level where bearish traders typically initiate selling. Moreover, this pattern implies that the emerging downtrend is likely to persist until the right shoulder is breached, an event marked by prices rising above the levels observed at the right peak. Trade exit signal. A trader riding the wave of a bullish trend may decide to lock in some profits upon identifying the third peak of the head and shoulders pattern. A price breakout through the neckline of the head and shoulders pattern signals the end of the primary trend and consequently necessitates an exit from all open trades aligned with that trend. This may also serve as a signal to place an instant or pending order to execute a trade in the opposite direction. The head and shoulders pattern as a trend continuation signal. The head and shoulders pattern as a trend continuation signal. Many chart patterns fail in certain situations, and the head and shoulders pattern is no exception. A breakout above the peak of the right shoulder or above the highest peak, the head, of the head and shoulders pattern may indicate a continuation or extension of the current uptrend. Such anomalies in the head and shoulders pattern are common on lower time frames for high momentum or trending assets such as cryptocurrencies. Conversely, the opposite scenario applies to inverse head and shoulders patterns occurring within a downtrend. Pros and cons of the head and shoulders pattern. Pro. Experienced traders can easily recognize it. Con. Novice traders may fail to spot it. Pro. Clear profit and risk parameters can be established. Con. The potential need for wide stop losses. Pro. Opportunities to profit from significant market movements. Con. Unfavorable risk-to-reward ratio. Pro. Applicable across various markets. The inverse head and shoulders pattern is an inverted head and shoulders formation, indicating a transition from a downtrend to an uptrend. What are some common variations and nuances of the head and shoulders pattern that traders should be aware of? Traders should be aware of several common variations and nuances of the head and shoulders pattern. One variation is a complex head and shoulders pattern, which includes additional smaller peaks or troughs within the formation, resulting in a more complex setup. Furthermore, traders should pay attention to the symmetry of the shoulders, as uneven shoulder heights may indicate a weaker pattern. Another nuance to consider is the slope of the neckline, as a steep or shallow neckline can impact the reliability of the pattern. Furthermore, traders should be wary of potential false signals, where a head and shoulders pattern may appear but not lead to a significant trend reversal. It's important for traders to carefully analyze these variations and nuances to make informed trading decisions based on the head and shoulders pattern. Can the head and shoulders pattern be used as a standalone trading strategy? While the head and shoulders pattern can serve as a valuable component of a trader's toolkit, relying solely on this pattern as a standalone trading strategy is generally not recommended. Successful trading often involves considering multiple factors, such as market trends, volume, and fundamental analysis, in addition to technical patterns like the head and shoulders. Using the head and shoulders pattern alongside other technical indicators and risk management strategies can enhance its effectiveness and provide more reliable trading signals. Therefore, while the head and shoulders pattern can be an important element of a trader's analysis, it is generally recommended to incorporate it into a comprehensive trading approach rather than relying solely on it. Are there any specific criteria for validating a complete head and shoulders pattern? Yes, there are certain criteria that traders typically use to verify a completed head and shoulders pattern. These criteria include: 1. Confirmation of a neckline breakout. A decisive breakout below the neckline is usually considered confirmation of the pattern's completion. Traders often look for an increase in volume accompanying the breakout to further confirm the signal. 2. Target projection. The distance from the head to the neckline is often used to project a potential price target for the subsequent downside move after pattern confirmation. This target is then used to set profit targets. 3. Retest of the neckline. After a breakout of the neckline, some traders look for a retest of the neckline from below as confirmation of the pattern. Such a retest can provide an opportunity to enter a trade at favorable levels. 4. Timing factors. Traders can also consider the duration of the pattern's formation and the duration of the preceding trend. A longer and more pronounced formation, accompanied by a significant preceding uptrend, can lend greater credibility to its validity. By analyzing these criteria, traders can better assess the likelihood of a head and shoulders pattern forming and make informed trading decisions based on the pattern's signals. Go for it! Like and subscribe to the Crypto Plus channel. Modern technologies have radically changed our society, where cryptocurrency has long been the means of payment. The concentration of capital and the growth of cryptocurrency turnover around the world is already today, where scattered small banks are being replaced by cryptocurrency cross-border payments. One of the most important modern decentralized tokens is Soviet gold chervonets, SOVAUCHER, built into the system of cryptocurrency exchanges and allowing financial transactions, which is the most suitable in the system of gaining your freedom and independence. You are on the right path, comrades.